It's very interesting right now because I'm getting two different types of emails. I get one email, we need to take on more risk. And then I get other emails saying, don't we need to be selling stuff and getting out of the market because this huge crash is coming? There's no evidence of that. There's no evidence that we're going to have one near term. Every week in the newsletter, I post some charts and graphs that are worth paying attention to. Every week we post what's called a risk range report. This risk range report also runs live on a daily basis on SimpleVisors. This report is very important to managing your portfolio. What this risk range report does, it looks at the standard deviation of how much a sector moves in a given month. So if you look back historically, basic materials on a monthly basis may increase or decrease by 1%. Technology may increase or decrease by 2%. What this table does is it looks at the average volatility of a sector in a given month or market. And so we have the 10 sectors of the market, then we have high dividend yield, S&P, and equal weighted S&P, and we have small cap, mid caps, emerging markets, international, gold miners, the dollar, and then bonds at the bottom. And so we provide the short-term weekly moving average and the long-term weekly moving average, and we look at the month-end price that starts at the beginning of the month and then measures it for the month. So when a sector or market trades well outside of its risk range, what it normally trades in a month, that's kind of a warning flag. So for instance, gold and gold miners were already well outside because of that run they've had. They're already well outside of their normal risk ranges for a given month. Energy was well under its risk range for the month. But what I want you to really focus on are the last three columns. And most importantly, the very last column. The last column is looking at the weekly moving averages and basically build a bullish indicator. If the short term is trading above the long-term moving average, that's bullish. If the short-term moving average is trading below the long-term moving average, that's bearish. Now, back at the beginning of this year, 15 of those indicators were bearish. We're now down to 3 as of last week. What that says is that with more and more of these markets turning bullish, the risk of a near-term big correction, like a 20 or 30% correction, is becoming less and less and less because you're getting more and more of these markets in bullish trending movements. If we start to see these bearish crossovers begin to return, one sector break down, then you see another sector break down, you see a market breakdown, crossover, that's telling you there's internal weakness building in the markets. When you start seeing this going from 3 bearish to 4 bearish to 5 bearish to 8 bearish, that type of thing, the market may still be going up, even though you're starting to register some of these internal dynamics that are getting weaker. It's telling you that there's risk building in the markets, and that's where you can get these 20% corrections. 2022, markets were down 20%. We don't have that dynamic right now. Things are actually improving. So while there's a lot of bearish headlines out there, the market's not saying that.
Catch me daily on The Real Investment Show. The link is in the description.